Welcome everyone to this webinar. The focus of this webinar is really to give lawyers and IP professionals an introduction to transfer pricing. So hopefully you're in the right place. If you're here and you're from a transfer pricing or tax background, then there may well be some nuggets that are useful for you, but I wouldn't blame you if you decided to drop out and wait for the slides, or if you decided to register for one of our other sessions, which are specifically for transfer pricing professionals. So what we're going to cover is we're going to give people a basic introduction to the main concepts of transfer pricing. So we'll spend some time going through those basics. We'll also talk about the wider stakeholders who are involved in intercompany transaction design. We'll look at some common errors when it comes to the interface between legal issues and transfer pricing compliance, transfer pricing analysis. We'll then look at the role of legal or the role of lawyers in transfer pricing compliance, and hopefully we'll learn some of the lessons from the past in terms of what has gone wrong and what not to do. We'll close then by looking at how agreements and legal issues fit into the transfer pricing and tax compliance lifecycle. And finally, we'll give some suggestions as regards next steps and practical considerations if you're looking after a corporate from an in-house perspective, or if you're working with corporates and helping with their legal issues. So first of all, just some housekeeping. We will share the slides after the event, so you don't need to worry about that. Second is that if you do have questions, then please use the chat function or the Q&A function, and we will do our best to pick up on those questions. Feel free to raise them as we go along, and I'll do my best to leave some time at the end to pick up on those questions. So first of all, just a little bit of introduction to who I am and who we are at LCN. So my name is Paul Sutton. I'm a corporate lawyer by background. I've been working in the space of the legal aspects of transfer pricing for the last 25 years or so. My entry point and the transition from my previous role, which was as a corporate M&A lawyer. So my entry point to transfer pricing was when I joined KPMG's law firm back in 2001. And I started working very closely with the tax and transfer pricing teams there and really developed this as a specialism. And that's what we are continuing in LCN. And our role is very much to look after the legal issues. And that means that we're working alongside transfer pricing professionals, both in-house and in private practice, because one thing we don't advise on tax, we don't do transfer pricing benchmarking or functional analysis. We're specifically and strictly focusing on the legal aspects. So let's start with the basics. What is transfer pricing? And the best way that I found of illustrating this is to think about a particular multinational group. So let's say it's Starbucks. I don't know how they are structured, but let's assume that the central management is mainly located in the US, which may or may not be true. And let's assume that the IP and intangibles is located in the US. So when you think about the relationship and the transactions between the US head office and the US IP owners and individual entities in individual countries like Germany, UK, China, whatever, from a commercial perspective and from a corporate perspective, there's clearly a transaction going on, or a series of transactions going on there. And those transactions are probably going to include some form of IP license, because when you think about Starbucks, its crown jewels are probably the trademark, the brand awareness, and the know-how in terms of operating coffee shops. So there's clearly IP there, and that is being made available by the US entity to the German entity, and probably also management support, and maybe also other forms of support as well. So the problem that transfer pricing is there to address is, what should the amount of the IP license fee or royalty be, and what should the amount of the fees for that management support be? And when you look at that from a US perspective, so from an IRS perspective, the lower the fees that the German entity is paying, the lower the profit are going to be declared in the US, and therefore the lower the corporation tax, and therefore the IRS has an interest on those royalties and fees being as high as possible. Whereas from a German tax administration perspective, the opposite is true. And it's possible that the amount of royalties or the amount of fees could actually wipe out profits and could mean that little or no corporation tax is payable in Germany, or would be payable. So transfer pricing is basically the set of rules that can look at related party transactions and tax the parties, the relevant parties, as if an arm's length fee had been substituted for the actual fee that was maybe paid between the parties. So that's basically the problem here. And it's obvious looking at this diagram that the US tax authorities and German tax authorities have completely opposite perspectives on all this. And in effect, the corporate is in the middle in trying to design a series of intercompany transactions which is defensible against challenges at either end. And if you're looking at a multinational group, then it's not just two ends, it's multiple ends of the transaction because there are multiple tax authorities involved. So that's basically the problem or the main issue that we're looking at here. And you can see on the right-hand side, in terms of transfer pricing disputes, or rather tax disputes arising from transfer pricing challenges, the amounts at stake can be very large. So we've got all these examples like Coca-Cola. 12 billion is the amount at stake in terms of the current and ongoing litigation. And the selection of companies here is just a small selection of groups which have been exposed to major tax claims due to allegedly defective structure design and defective transfer pricing documentation. In addition to transfer pricing challenges, the legal design and the substance of the intercompany transactions can also affect other categories of tax risk. For example, corporation tax deductions may be denied. So if you look at these transactions on the diagram from a German perspective, the German entity will want to claim a deduction for the amount of the intercompany charges that it pays. And it can be that in addition to transfer pricing challenges, which relate to the quantum of the charges, there can be a binary challenge because a number of tax authorities will routinely deny a corporate tax deduction entirely if there's a lack of documentation, including a lack of contemporaneous agreements. And there are various tax authorities which have stated that this is the default position, including Mexico and Germany and so on. And then just to give another example of a category of risk or why it matters to get your intercompany transactions designed right and implemented correctly from a legal perspective is withholding taxes. So depending on the jurisdiction, here we're talking about payments from Germany to the US, it may be that withholding taxes are payable. So rather than paying the full amount to the US, a portion of that may be payable to the German tax administration directly. Rates of withholding tax range from country to country, but generally are in the bracket of 15% to 30%. And the application of withholding taxes can be very sensitive to the substance and the form of the intercompany transactions. So depending on whether the payment is in the nature of royalties, withholding taxes may be payable, but whereas in other countries or in some countries, a payment in the nature of fees is not subject to withholding taxes. And because of the immediate cash flow impact of withholding taxes, getting that analysis right in advance and documenting the transaction in a way that is consistent with the withholding tax position is absolutely critical. So just to look briefly at some basic transfer pricing terminology. So one concept or one term is transfer prices. So this is generally referred to or indicates the price at which one enterprise transfers goods or licenses IP or provides services or actually makes loans to associated enterprises. So broadly members of the same group, but they don't have to have that group relationship. So transfer prices is a key concept. Controlled transactions. So this is the terminology used in the OECD transfer pricing guidelines to refer to transactions between enterprises that are associated, in other words, under common control. Then we have the arm's length principle, or the US equivalent, which is the arm's length standard, which is really the core concept in transfer pricing. And that is that the amounts payable between related parties or the under controlled transactions should be equivalent to those which would be payable between independent or unrelated enterprises under similar conditions. And that links into the next key concept, which is comparability. In other words, applying the arm's length principle means that you're looking at two things. Firstly, you're identifying what is the controlled transaction, which is the one between the related parties, and what are potentially comparable uncontrolled transactions, and are they comparable? And they are comparable if none of the differences would materially affect the relevant analysis, affect the relevant pricing. And then finally, on this slide, we have the concept of transfer pricing functional analysis, also referred to as FAR analysis. So what this looks at is that in relation to each of the enterprises involved in a particular transaction, you look at, well, what are those respective enterprises doing functionally? You know, who is making decisions, who is actually carrying out sales functions, who is actually negotiating contracts with customers and so on. So what are the functional responsibilities being undertaken there? What are the assets being used or contributed? And what are the risks being assumed or controlled by the parties in the context of that transaction? So that means that, yes, the legal form is important because it's often the first port of call in a tax audit. The way that transfer pricing analysis works is that it looks as well at the functions, the assets, the risk involved in that transaction, and which enterprise or which parties do what in that context. So just to give you another example to think about in terms of how transfer pricing works and how it actually needs to be operated in real time. If you imagine a SaaS business, so entity A is, let's say it's a global SaaS business, but headquartered again in the US. And let's say all the functions, all the IP are held in the US and it just makes sales internationally. Okay, so this is the starting point. Entity A then acquires entity B, which is maybe another SaaS business. And let's say entity B is in Germany. And so when you think about a typical acquisition of this nature, you'd expect that entity B has its own technology, has its own IP, maybe has its own sales team, own customer contracts, its own management team, and so on. And so one of the questions that needs to be decided actually prior to the transaction happening, prior to the acquisition happening, is what is Group A going to do with entity B, and in particularly the IP associated with entity B from and after the date of the acquisition. And there are different options here, each of which has a major transfer pricing implication, has an operational implication, and has tax implications as well. So just very broadly, one option would be, well, you leave all the legacy B IP in Germany, which means that to the extent that A is utilizing that IP, then it will need to pay a license fee. So that means that you would need to design, document, and price a license transaction between B as licensor and A as licensee. So that's one option. Another option would be immediately after the transaction, you actually hive up the IP from B to A. So that would basically effectively be a sale of the IP, which would need to be priced from a tax perspective. And it may be that exit taxes or corporation tax would be payable in entity B's country, so Germany, in connection with that sale of the asset. And if that does happen, then it means that the role of entity B in terms of its R&D function would change, because whereas pre-acquisition, entity B's R&D function was carrying on that work for entity B's own benefit, going forward, if the IP owner is now A rather than B, then it means that that R&D function is probably being carried out by B for the benefit of A, which means that A needs to pay a fee for that R&D service. So that fee needs to be priced and documented as well. And for those corporate lawyers on the call, you'll understand, it's very problematic to try and backdate these kinds of transactions. So you can't just ignore the issue and then 3 years later say, oh, actually, we'd have preferred to have transferred out that IP from B to A, and let's try and document that after the event. Let's try and backdate documents to do that. That's not going to work from a corporate perspective, from a statutory accounting perspective, from a tax perspective. So that means that the challenge is very much a real-time challenge, which is to design appropriate group structures in advance, implement them in real time. So that includes implementing them legally through appropriate agreements, to then operate those arrangements in each financial year, and then report on them after the event on a year-end basis. In other words, as part of the corporation tax filings. And then the critical thing that I think everyone's focus should be on is tax audit readiness and due diligence audit readiness. So we may have a set of transactions occurring in 2025. Maybe that the tax audit doesn't happen in Germany for 7 years, 6, 7, 8 years, by which time maybe the people involved have left. And so it's critical to document the arrangements contemporaneously from a legal perspective, from a commercial rationale perspective, from a transfer pricing and tax perspective. So just moving on to some more basic terminology, you may have heard of the term BEPS. BEPS stands for base erosion and profit shifting. In other words, it refers to strategies that some corporates have and continue to engage in, which is attempting to artificially move profits from a higher tax country to a lower tax jurisdiction. So BEPS is effectively the evil which transfer pricing rules are designed to counteract. But confusingly, BEPS also refers to the so-called actions which were adopted by the relevant OECD group to combat profit shifting. So then we have the OECD transfer pricing guidelines, which are basically a compilation of various reports by the relevant committee within the OECD that attempts to create a common framework for resolving transfer pricing disputes between tax administrations and multinational enterprises. And so the latest version of the OECD TP guidelines is the 2022 edition, but in reality, there are additional reports that come out in between each official update. Another term is ICA, so this is an abbreviation for intercompany agreements. In other words, agreements between related parties. Sometimes ICAs are misleadingly referred to as transfer pricing agreements. I would say that's poor use of terminology because it suggests that the agreement is just there for transfer pricing. Actually, that's not the case. Another term for you to be clear about is an APA or advance pricing arrangement, which sounds similar, but it's actually different. So what an APA is, it's an agreement between a multinational group and one or more tax administrations about how to price a particular transaction. So in a Starbucks example, it could be a bilateral agreement or bilateral APA between that group the tax administration in Germany and the US agreeing that, well, given a certain set of conditions, the methodology for determining the royalty rate for the IP is set at that particular definition or specification or number for a certain period of years. So the upside of APAs is that they do give certainty. Downside is that typically APAs take years to negotiate and conclude. So really 3 years is the minimum that you would expect. Another common term is entrepreneur. So in the context of a group structure is looking at which entities are acting as entrepreneur. So this is not a technical term, and it's generally used as a shorthand to describe an entity which assumes significant risks and also receives the residual upside benefits of the particular business or endeavors being a success. And the converse of that, you may come across the term limited risk distributor or LRD. This is also not a technical term. It's not a term of art. It generally refers to an entity which acts as a distributor within the group, but is thought of as carrying out routine functions only. In other words, it's a reseller which is basically acting on the instructions of head office or the entrepreneur and is not intended to bear significant risks. So those are some of the key terms that you'll come across when you're working in this space. Next thing to explain is just the three-tiered approach for transfer pricing documentation. I'm not going to read everything on this slide, but basically there are three categories of documentation. One is the master file, and the intention is that this gives an overview of the group, how it works, what intangibles it owns, which entities legally own them, and also the master file should contain a list of important agreements related to intangibles. Then you have local files which are prepared for each country in which the group is present, and it contains more detailed information on all of the transactions that affect the entities in that jurisdiction. And the local file should include copies of all material ICAs. And then we have CBCR, stands for country by country report, which is more like a spreadsheet, if you like. It's aggregated data relating to all of the constituent entities in the group, lists out where they are, the taxes paid, number of employees, certain other indicators. So this is intended to allow tax administrations to focus on where they should direct their efforts in terms of tax audits. And generally, a country by country report is only required for groups with annual revenues of 750 million euros or more. One thing that's really important to understand in transfer pricing is the distinction between after the event documentation. So that includes master files, local files, and CBCR. So these are prepared following the end of the relevant tax year, and it's a look back to say this is what happened, as opposed to forward-looking transfer pricing policies and price setting policies, which is actually what needs to happen in order to design, implement, and then operate certain arrangements. And we'll come back to this distinction a little bit later. So this slide attempts to give a really quick rundown of the major transfer pricing methods or the major transaction types that you're likely to come across. I'm not going to go through all of all the words on the slide because there are rather a lot, but just from the top. So we have the cup method that looks at the prices or transactions between unrelated parties and references the terms and conditions and the pricing of that, and then that becomes the reference point for the pricing and design of the controlled transaction. Then you have the resale price method. So that's for an intercompany distributor or intra-group distributor. So that looks at the price at which the product is resold to the third-party customers. It deducts an appropriate gross margin for the distributor, and then what's left may be regarded as the arm's length price that is paid to the entrepreneur or the intra-group supplier. Then we have the cost plus method, which looks at the costs incurred by the relevant supplier, adds a markup like 5%, 10%. And if there are multiple beneficiaries, multiple recipients, then there may need to be there will need to be an allocation key that defines how is that central cost allocated between the different service recipients so that an appropriate share is paid. Then you have the profit split method that looks at the respective contribution of two or more entrepreneurs usually, and the combined profits achieved out of those entrepreneurial activities are then split between those entities in a way that reflects the value of their respective contributions. Then we have the transactional net margin method that looks at one of the parties, such as a distributor. It looks at a particular financial indicator like operating profits and uses that as the reference point. So it will be based on third-party comparables saying, well, an equivalent third-party distributor is likely to earn an operating margin of a certain amount, and it applies that to the pricing of the transactions involving that distributor. And then finally, we have cost-sharing arrangements, which often, but not always, relate to IP and intangibles. And that's where two or more parties within the group jointly pool their costs and pool their efforts in developing and maintaining the relevant IP. And it shares the costs between the parties by reference to the respective benefits that those parties, those group entities, are likely to derive from using the intangibles or using the combined developed assets. So that's a very quick rundown of the methods. I'd like to talk about risk here, because if you're coming at this from the perspective of a lawyer, this is probably something that you will instinctively factor into your work and factor into the way that you look at the world. The reason why I've got a picture of a car on the right-hand side is it just illustrates that the way that you think about risk in third-party transactions also applies to intergroup transactions. So if you imagine that you're buying a second-hand car, maybe a one-year-old car, you might have the option of buying it from a dealer or from just a guy on the street. And the chances are that you would be willing to pay more for the same specification of car, same age. You'd pay more to the dealer than you would from just some individual that you've never met before. And part of the reason is that the structure of the transaction, including the transaction terms, means that you're bearing less risk if you're paying more. And one of the risks in buying a second-hand car is latent defects. In other words, there's something wrong with the car. You can't spot it when you have a look at it. You can't spot it on the test drive, but it is there. And if you're buying from a dealer, then you'd expect to get some form of contractual warranties or guarantees so that if there is that kind of defect, then maybe it's fixed for free. In other words, it moves that risk, partially at least, away from you as the buyer of the car and over to the dealer to assume that risk. And as long as the dealer has the financial capability to meet these kind of claims, then you would price the transaction accordingly. And so the purpose of this discussion is to say that it's baked into the OECD transfer pricing guidelines that if you're analyzing a related party transaction, you also need to look at, well, what are the relevant risks that we're talking about here? Could be product defects, could be product recall claims, it could be just the market risks, it could be exchange risks or currency risks or something like that. So the first step is to identify what are the risks that are economically relevant here. And then you need to look at how are those risks allocated between the entities. And although the legal terms of the intercompany agreement are not the only consideration here, they are a key consideration here, and they affect the pricing in a very similar way to your pricing of buying a second-hand car from a dealer or from a guy on the street. So thinking about risk and thinking about how statements in the transfer pricing documentation are supported by statements in the intercompany agreements or terms in the intercompany agreements is a critical role of legal in supporting the group in terms of minimizing tax challenges. Another key concept that I'm just going to touch on here, we actually run more in-depth webinars on this point, is the concept of intangibles and DEMPI analysis. So intangibles or intangible assets is a term used in the OECD transfer pricing guidelines to refer to anything which it's not a physical or financial asset, it's capable of being controlled or owned for use in commercial activities. And number three, it's an asset whose use or transfer would have been compensated between independent parties in comparable transactions. So it's very broad, but it includes everything that we as lawyers would think of as IP, and it's a little bit wider than that. And unsurprisingly, because we all know that intangible assets, IP, tend to account for at least 90% of the enterprise value of any group. And therefore, it is particularly important in pricing transactions between related parties to clearly understand what is going on from an intangibles and IP rights perspective. And that means that within the OECD TPG, there's a particular methodology and sequence of steps for analyzing or delineating, as the term used, a transaction which involves intangibles. And that includes looking at these so-called DEMPI factors. So DEMPI stands for development, enhancement, maintenance, protection, and exploitation of the intangibles. And it's looking at, well, in the context of a particular transaction, who is doing what, or which entity is doing what in terms of developing the intangibles, enhancing them, maintaining them, protecting them, and exploiting them. And similarly, so it's looking at the functions, it's looking at who is bringing what to the party in terms of assets, and who is bringing what to the party in terms of managing risks. And when you're thinking about risk here in the context of intangibles, it includes R&D type risks. In other words, if you're looking to create the next generation of whatever, whether it's a product or software or something like that, there's always the risk that certain types of research or R&D activity may completely fail to produce any usable results, the risks of blue sky research. And so as part of the DEMPI analysis, it needs to look at, well, what kind of activities of that nature is going on and which entities are managing and controlling those risks. And you'll see that these steps very much involve the legal point of view, because as part of this, you need to identify not only what are the intangibles, also what are the legal rights associated with those intangibles, where do they actually sit, what are the contractual arrangements between the parties, and it's only after you've identified that you can start to price the transaction. And that may mean a profit split, or it may mean a royalty for IP or fees for R&D services. So it's critical to have proper understanding of the legal. And again, when we're talking about intangibles, I'm sure this is something that you'll be very familiar with as lawyers, but there are a number of different categories of intangibles. It's not just product IP, like patents and designs and recipes. It's also process type IP or know-how, like manufacturing know-how. There's trademarks, but trademark registrations or logo registrations are not the full story. There's also domains and social media accounts and so on. There's also softer IP in the form of customer connections, goodwill, customer contracts, and there may also be process IP in terms of sales and marketing. So obviously this is a massive area, and the purpose of this conversation is really just to trigger in your mind the fact that actually this is something that is so critical in terms of managing tax and transfer pricing risks and has a really significant legal element to it. So we've talked about some legal aspects of transfer pricing analysis. I'm not going to dwell on the various guidance statements that have been issued by different tax authorities and by the OECD, but probably just scanning these quotes here. you'll get the picture that transfer pricing analysis, and transfer pricing documentation, in order for it to be robust, it needs to be consistent with the intercompany agreements, and it needs to fit in with what the agreements actually say. And looking at the bottom, we've got an even stricter rule that applies in some countries like Germany that says the relevant point in time for pricing a transaction and for applying the arm's length principle is actually the date on which the relevant agreement is concluded. It's not the date on which the relevant transaction is performed. And I think that when you think about how the real life works, you lock in the price of your holiday when you actually make the booking. It doesn't matter when the holiday actually is, you lock it in when you make the booking. Similar to other transactions, whether it's commodities transactions or insurance policies and so on. So the world is changing in terms of TP compliance away from what probably the received wisdom was maybe 10, 15, 20 years ago. You just need to do TP after the event. Actually, the challenge is to do this in real time now, in advance. So that was the basics of transfer pricing. I appreciate it's covered a lot of ground in a short amount of time. Common errors, we're going to look at the left-hand side and the right-hand side here, which are two sides of the same coin. So errors in transfer pricing policies and transfer pricing documentation. And a number of errors in recent cases have been because the documentation was inconsistent with the intercompany agreements, or the terms of the agreements were actually ignored, or there were incorrect assumptions as regards the legal fact pattern, or there was actually no commercial rationale for the transactions. In other words, no person in their right mind would ever have signed an agreement documenting a transaction in the way that it was claimed. So that's errors in transfer pricing documentation, which directly leads to Coca-Cola type risks. And then you've got errors in the intercompany agreements, which includes groups that have no agreements or gaps in their agreements. Maybe they get the parties wrong. It's very common that agreements actually contradict the transfer pricing policies or don't reflect the pricing, or inconsistent with the actual conduct, or not kept up to date. And the bottom line is there central control of ICAs? In other words, do you have your central archive kept up to date? So that's an overview of what does go wrong, has gone wrong, and has been reflected in a number of high-profile cases. I mentioned Coca-Cola previously. I don't think I've got time to go through the whole fact pattern here, but effectively, what this case related to was a pricing methodology or a pricing approach that was applied over a certain period. So it's 2007 to 2009. It was actually a form of profit split. The problem was that one of the problems was the agreements in that period totally contradicted the transfer pricing methodology which was being put forward, including as regards the pricing. So not one of the agreements actually referred to the 10-50-50 profit split methods that was claimed. And all the agreements contradicted the transfer pricing policies as regards the ownership of intangibles. And what the US tax courts said was, sorry guys, you are a big corporate, you had complete control as to the form and content of the ICAs that you put in place. You don't get to overturn or disavow your own agreements. You don't get to bring economic arguments to say the agreements were wrong. It's only the IRS that gets to bring that kind of claim. And so basically, that was a major contributing factor to the fact that Coca-Cola lost in the 2020 decision of the US tax court and is still trying to appeal that decision. So looking a little bit more broadly than transfer pricing, we touched on this on the earlier Starbucks example. But transfer pricing, although it is a very important stakeholder, and the amounts of tax at stake can be very, very significant, it's only one of a large number of stakeholders that include withholding taxes, corporation tax deductibility of expenses, enforceability of intellectual property, exchange control, and so on. And so the better way to think of this is going back to what is the challenge is to design appropriate transactions that make sense commercially, that make sense from a transfer pricing and a legal perspective, implement them in real time in intercompany agreements, and those agreements then become a vital, if not a central reference point for recording the nature and substance and pricing of the relevant transactions for all these different purposes, including VAT and data protection and so on. And that's why it always requires a holistic, cross-functional approach to design and implement intercompany transactions. And it's why lawyers perform such a vital role as part of the ecosystem to protect corporates. So that brings us nicely on to, well, if you're listening to this from the perspective of an in-house legal counsel, or if you're a corporate lawyer in an advisory firm, what is your role? Well, the reason why we got the red flag here is that to a large extent, why did Coca-Cola happen? Why did no one notice the discrepancy? I think the only explanation is that people weren't doing their job, unfortunately. In other words, what should have happened is that someone should have looked at the agreements, looked at the TP policies, and just raised a red flag saying, something here does not look right. And really, that's the most important thing that can happen here. If you drill down a little bit more, it's making sure that the matrix of intercompany transactions is correctly identified and designed, who is doing what for whom. Ensure intangibles are correctly identified. This is massive, given, as we are saying, intangibles probably account for 90% of enterprise value. Making sure that you've understood for your group what are the crown jewels, how are you going to protect them, and how does that factor into the economic analysis? That is absolutely foundational. And then the rest of the items on this list ensure that the contractual model or business model of the group is correctly understood, because often it's not. Assess the impact of intercompany transactions on historic corporate transactions and vice versa, and on future corporate transactions. And at the bottom here, one of the key functions is make sure that the portfolio of intercompany agreements is maintained in an audit-ready and transaction-ready state. So it may not necessarily be the legal function which actually has ownership of that, because often this falls within tax, which is where it naturally belongs in many cases. But it's part of the role of legal to have at least a dotted line relationship to make sure that that key function is being taken care of. I mentioned before that the concept of transaction matrix. This is not a complex idea, and here's a really simple way of expressing that. What it means is that looking at a particular group or subgroup, what are the categories of intercompany transactions? So you might have R&D services, which are charged on a cost-plus basis. You might have management services. You might have a profit split. You might have a cost-sharing arrangement. You will have intercompany loan transactions. So part of the key role of legal here, working alongside the tax and TP function, is making sure that you have correctly identified each of the transaction types, and you've understood who or which entities are the suppliers or sellers or licensors, which are the recipients or buyers or whatever, and what is the nature of that transaction from a headline commercial terms perspective, and what is the pricing methodology? So is it cost plus? Is it profit split? So this is the number one most important document, I would say, in order to bridge the gap between transfer pricing analysis and the legal input required. One of the other things that I'd like to share with you briefly is something that often needs to happen, which is a health check review, because many groups are still operating on the basis of agreements which are totally outdated. Maybe they were put in place 10, 15 years ago, haven't been properly reviewed since then. Maybe it's a Coca-Cola situation that everyone just assumes, well, someone would have looked at them at the time and they must be right. Well, actually, no. And so this is a basic format that we use for a health check review of intercompany agreements. And it's very simple. On the left, it looks at the statements made about that transaction in the transfer pricing policies. On the right, it maps that against the relevant provisions of the agreements and says, well, does it match or not? And unfortunately, in this example, and we're using a traffic light system, by the way, there was a lot of reds, not much green, and quite a bit of amber too. And it's that kind of basic attention to detail which is essential in order for everyone to do their jobs here. So just going a little bit more deeply into ICAs in the compliance lifecycle, this is really illustrating the fact that given that the challenge is plan, implement, operate, and then file, and then later defend, that means that given where we are right now, so we're in November 2025, it means hopefully for your organization, your agreements for financial year 2025 are already in place, so signed and dated, and that's because you did the right work in 2024 to plan and implement them. And it means that your group is going to be in the best position when it comes to making the corporation tax filings and TP filings in 2026. And also it's in the best position to defend its transfer pricing and tax positions later. It also means that in terms of the next upcoming financial year, so 2026, you need to be at the tail end of planning and implementing those agreements ready for the new financial year. Now, obviously, a lot of groups are in transition because the TP world has changed massively. What was acceptable 3 years ago or 5 years ago is no longer adequate. And so that means that you may be looking at this from the perspective of, well, I'm in the legal function and I know we don't have our agreements in place for 2025 yet, maybe not for 2024 either. What do you do? Well, the answer is you do what you can do to catch up and get into a proactive position so that the ongoing state is compliant and collectively you're doing what has to be done to protect the group's position here. So I'm just going to pause at this point and see if anyone did have any questions or anything from a Q&A perspective. I can see someone has asked, can we obtain a copy of the slides? Yes, absolutely. We'll share them after this session. So you'll get a copy in your inbox. So in case people are still thinking about any questions or maybe I've done a great job and it's all crystal clear, I'm just going to go through some practical considerations if you are faced with this situation where you know that a group that you're looking at after, whether it's advisor or in-house, is not in the position it should be. So here's a suggestion as to a practical approach. So number one is getting a handle on what is the group structure. So from a high level perspective, what are you dealing with here in terms of countries, entities, and TP policies? What does it look like? Number two is what do you have right now in terms of ICAs? If you don't have a central archive, now is the time to do that. In other words, just create, even if it's just a SharePoint folder, create a central repository where you can put copies of signed and dated agreements. Remember, when you're thinking about your archive, you're doing this from a financial year by financial year perspective. In other words, you need an archive for your agreements in financial year 2025, probably a separate one for 24 and so on. So you need to structure your archive so that it is ready for the audit, which comes maybe in a number of years' time. And as you're doing that, you're just getting a handle on when were these agreements last reviewed or last updated. Number three is thinking about the impact of acquisitions and transactions. And this is both backwards looking and forwards looking. So backwards looking is thinking about what corporate transactions have there been in the history of the group. So like that SaaS example that we talked about, because those acquisitions will need to be structured. And if they haven't been structured already in terms of how the IP is integrated and so on, then now's the time to flag that as something which almost certainly needs to happen. You're also looking ahead at possible transactions or exit or IPO in the future. And I guess it goes without saying, if you're a private equity owned group, by definition, you're envisaging an exit. And so that's probably going to accelerate the focus that you're going to have on getting your act together, getting your house in order as regards not just transfer pricing documentation, but the legal foundations of that. Number 4 is that you need to identify who are the different stakeholders that need to be involved in the design of intercompany transactions and agreements. And so that goes back to the previous slide. So it's not just tax and transfer pricing. It's also probably going to be IP enforceability, withholding taxes, VAT, and so on. So that means that you're going to end up with a list of different stakeholders. You'll probably have a core group who is going to drive forward the project for getting your agreements and the legal aspects of your TP in order. But you're going to have a list of wider stakeholders who will need to be involved before you finalize those agreements. Number 5, there's always the so what test, which is, okay, so our transfer pricing is not compliant, our agreements are not compliant, so what, who cares? You're probably going to want to do a high level assessment of what is the amount at stake in terms of transfer pricing challenges, denial of corporation tax deduction, withholding taxes, VAT, and so on. And that's because whatever approach that you're going to propose needs to be proportionate, and you're going to have to get people on board so that you can explain why what happens needs to happen. And linked with that, item number 6 is the risk appetite of the organization. So obviously, if you're an IPO path, you probably got relatively low tolerance of bad surprises, unexpected tax claims, or unexpected things coming out of due diligence. So you probably have a low appetite for risk. There may be certain other organizations which are very entrepreneurial. Maybe they're not planning any kind of exit. They may have a higher tolerance for governance risks and tax risks. And it's important to make a high level assessment. Number 7, you need to have an awareness of upcoming deadlines and projects. That might include exits, but it would also include, you may be expecting, or your tax colleagues may be expecting, a tax audit in certain countries within a certain period. Next consideration item 8, is in the context of all the above, is deciding where to start. It may not be practicable to go back and fix errors from 5 years ago. Maybe it's better to start in the current financial year and use that as the reference point to get your legal foundations and your transfer pricing foundations in place. And then you can use that as the starting point for addressing other years as well. Item 9 is obviously thinking about the resources available internally and externally, and looking at what support you're going to have and what you need. And then finally, 10, ongoing roles, responsibilities, and processes, not just for the immediate cleanup project, but also going forwards in terms of how you're going to manage this set of needs on a steady state basis going forward. So we're coming to the end of this session, and I'm just going to explain how we fit in, how we help. As I explained, we are corporate lawyers who happen to specialize in the legal aspects of transfer pricing. And so the way that we work with corporates is that we complement and work alongside their legal team, because obviously they need to have a handle on what's happening, and there'll be certain strategic decisions that they need to be involved in, such as the management of IP in particular. We'll also work, generally speaking, our most direct communication line is with the tax and transfer pricing function, or the tax and transfer pricing advisors. And so the kind of things we do are ICA health checks, ICA drafting, matrix design, as well as restructuring projects. At the bottom left, we do have certain clients, especially within private equity owned groups, for which we effectively provide an outsourced service to keep their intercompany agreements up to date and maintained going forward. And then on the bottom right-hand side, so almost all of the clients and corporates we work with have an in-house legal function. And naturally, there's a desire, and in some cases, a policy to use in-house legal capabilities as much as possible. So one of the ways that we help corporates in that way is actually we make available toolkits. So we have toolkits of intercompany agreements and checklists that can help in-house teams prepare tailored agreements, but starting from the right starting point, because intercompany agreements do need to have very different functionality as compared to typical agreements. We also provide training, so more in-depth training for in-house legal and tax teams on specific considerations in terms of designing and implementing agreements, as well as in-depth training on specific transaction types like profit splits and CSAs and so on. So we provide very flexible support either to do the intercompany agreement work, or we can support you so that you can do it yourself and not hopefully have to make the same mistakes that other organizations like Coca-Cola made in terms of their legal implementation. So it looks like there may not be any additional questions. So in that case, all I can say is thank you very much for joining. Thank you so much for spending the time with us. We will be in touch to share a copy of the slides. If you do have any questions, anything that you would have wanted to ask or raise with us, please feel free to reach out, and we're always happy to have a conversation. So thank you very much indeed.